With rules changing every year, it's no wonder things can get confusing. But fear not, I'm here to guide you through it all. Welcome to Groww NRI, I'm Karunya, and in this video we will discuss who is an NRI, what is taxable income for NRIs, eligible tax exemptions for NRIs, tax deductions for NRIs, and as a bonus, I will also discuss NRI tax forms, deductions NRIs cannot claim, and DTAA. But before we get into the details of 2024 NRI taxation, let's discuss a bit about the residency status. So who's an NRI? While calculating your Indian tax, determine your residential status by answering two questions. Were you in India for at least 182 days during the financial year? Or were you in India for 60 days in the previous year and have lived in India for 365 days in the last 4 years? If your answer to any of these questions is yes, you're a resident Indian. If your answer to both is no, you're an NRI. Simple, right? Well, not really, because NRI status is governed by two laws, the Income Tax Act 1961 and the FEMA Act. If you're curious to learn more about how NRI status is determined by these laws, check out this video. Alright, now that we've sorted out your tax status, let's jump into the next segment and find out what is taxable income. You might be wondering, why are we placing our focus on understanding NRI status? That's because as an Indian resident, your global income is taxable in India. But if you're an NRI, you only pay taxes on income earned in India. Before we proceed, let's clarify the terms earned and accrues in India. Earned in India refers to income that you've received or gained through your efforts or investments while in India. It includes salaries, wages, profits, and other forms of compensation earned within the country. On the other hand, accrues in India refers to income that is due but has not yet been received. It could be interest on investments, rent from properties, or dividends from stocks that have accumulated but have not been paid out yet. You can check this table for better clarity on which source of income from India is taxable. Now let's zoom in on the first taxable income for NRIs, the income that arises from house property. When you own a property in India, whether renting it out or lying empty, any income you make from it is subject to taxes in India, even if the money goes straight to your bank account outside India or into your NRI account. It is still considered taxable income in India. Here's the good news. Just like residents, NRI can claim 30% deductions on property taxes and the interest on any home loans you took. And remember those big loan payments you made every year, right? The ones that are part interest and part principal. You can claim the principal part of those payments as a deduction under Section 80C. Even the stamp duty and registration charges you paid when you bought the property can also be counted towards this deduction. Oh, and one more thing to remember. When you're renting your property, the tenant has to deduct a TDS of 30% before transferring money to your account. So when a resident makes any payment to an NRI, they must submit Form 15CA or 15CB online to the Income Tax Department. There are still other sources where one can receive income, but what can that be? Let's discuss this in our next section. Income from other sources. Other sources of income can include bank deposits, business income, and investment earnings. Here's what you need to know first: taxation of bank deposits. I'll keep it simple. The interest you are making from your FDs or savings account, all of this is taxable. However, if you're earning interest from NRE or FCNR accounts, consider it tax-free. But do not forget that the interest from your NRO account is fully taxable. Second, taxation of business income. When it comes to your business ventures, any cash flow coming in is taxable. That's why keep your earnings in check and stay ahead of taxes. Third, taxation of investment income. Under this, NRIs are subject to a 20% tax on income earned from specific investments. And one interesting fact, if investment income is your sole income for the year and TDS has been deducted, you may not need to file an income tax return. There is one more way to earn income, and that is from capital gains. But how are they taxed in India? Let us check it out in the next part. When you sell something valuable like property or investments, any profit you make from it is called a capital gain, and in India, it's taxable. When you sell a property, the tax rules factor in two scenarios. First, long-term capital gains. If you sell an asset after holding it for a period longer than 24 months, you are liable to pay an LTCG tax at a rate of 20%. Second, for short-term capital gains, a 30% tax is deducted. If you sell an asset within a holding period of 24 months from acquiring it, you will face STCG tax of 30%. Now that we know which income gets taxed for NRIs, the next step is to understand which ITR form you should pay. Under income tax laws, the tax form you use depends on how you earn money in India. Since FY 2017-18, non-resident Indians are required to use ITR2 for filing returns in all instances except when reporting business income. For non-resident Indians receiving business income, the income tax return to file is ITR3. You know what? We've talked a lot about paying taxes. Now let's shift to our next topic, which is about saving taxes. Let's explore the exemptions that can help you keep more of your hard-earned money. First, interest earned on NRE or FCNR accounts is tax-free. Government-issued bonds and savings certificates. They also offer a tax exemption on interest earnings. Lastly, let's explore how capital gains can be exempt under certain conditions. First, by selling a house or property held for over 24 months and reinvesting the proceeds in another property or depositing them in PSUs or other banks. Next, for any property besides a house, capital gains can be avoided by investing in the construction of a new house or purchase. Finally, by investing long-term capital gains from immovable property in 54EC bonds, such as those from the National Highway Authority of India or Rural Electrification Corp, with the exemption capped at a maximum of 50 lakh rupees. Now that we have covered tax breaks, let us dive into another money-saving strategy, tax deductions. In this segment, we'll cover which deductions NRIs can claim and which are the ones they cannot. Let's first start with deductions under 80C. NRIs get a total combined limit of 1.5 lakhs under Section 80C, and here are a few ways you can claim this deduction. First, if an NRI or their spouse or child has a life insurance policy, they can claim a deduction for the premiums paid as long as they are less than 10% of the sum assured. Second, any fees paid for the education of up to 2 children in India, whether for school, college or university, can be claimed as a deduction. Third, if an NRI is paying back a loan they took to buy or build a house in India, they can deduct the principal repayments from their taxable income. Even expenses like stamp duty and registration fees can be included. Fourth, NRIs can claim tax deductions by investing in ULIPs, which offer insurance and investment in one plan with a 5-year lock-in period. And you can claim deductions for the premiums paid for yourself, your spouse, and your children. Fifth, NRIs can claim deductions for investing in ELSS funds of up to 1.5 lakh rupees. The next deduction can be claimed under Section 80D. NRIs can claim deduction for health insurance premiums paid up to 25,000 rupees for self, spouse, and dependent children. Additionally, deductions of up to 25,000 are available for parents' insurance. But here's the catch. If the premium paid is for resident senior citizens, the limit is raised to 50,000 rupees for self, family, and parents, excluding senior citizen NRIs from this benefit under Section 80D. You can also claim up to 5,000 rupees for preventive health checkups within the existing limits. And if you're paying medical expenses for resident senior citizens, you can claim up to 50,000 rupees for them too, as long as any health insurance policy does not cover them. So we've covered how 80D handles health-related deductions. But what about education? That is what we will discuss under 80E. NRIs can claim a deduction of interest paid on education loans. Now, this applies to loans taken for higher education for themselves, their spouse, children, or a student under their legal guardianship. There's no limit to the deduction amount, available for maximum of 8 years or until the interest is paid off, whichever comes first. However, the deduction does not apply to the principal repayment of the loan. Now that we've taken care of education expenses, let's turn our attention to giving back. In the next segment, deduction under 80G, we'll explore deductions for donations. Section 80G of the Income Tax Act allows deductions for donations made to eligible charities or funds applicable to individuals and companies. The deduction can be up to 50% or 100% of the donated amount, depending on the recipient. However, not all donations qualify, so it's essential to ensure the recipient is eligible under Section 80G. Now that we've explored deductions for donations, let's focus on savings under 80TTA. NRIs can claim a deduction on savings account interest up to 10,000 rupees, just like resident Indians. Alright, so we've covered a range of deductions from education to health, donations and savings, but here's a thought. Are there any deductions that NRIs miss out on, especially from Section 80C? Let's check this in the next topic. Deductions excluded for NRIs. First, NRIs cannot open new PPF accounts. However, they can maintain existing accounts opened while they were residents. Second, National Savings Certificates or NSCs. Third, Post Office 5-year deposit schemes. Fourth, Senior Citizen Savings Scheme or SCSS. I know it's not easy to keep track of all the deductions or exclusions, and watching the video on the loop can be quite a task. So feel free to take a screenshot of this image for your reference. Who does not love saving money? And that is exactly how tax exemptions and deductions come to our rescue. But there's another way NRIs can save on income tax in India, and that is through DTAA. Picture this, you are an NRI living and working abroad with ties back home in India. Now, without a DTAA in place, you could end up getting taxed twice on the same income, once in your country of residence and again in India. Not ideal, right? That's where DTAA swoops in to save the day. It's like a special agreement signed between two countries to prevent this double taxation headache. I know we've covered a lot already, so here's a quick rundown on DTAA. DTAA sets out clear rules on who gets to tax what. For instance, if you earn a paycheck abroad, your host country might tax that income, but if you're making money from investments, India might be the one to tax it. This way, NRIs avoid getting hit with the double taxes on the same cash. Plus, some DTAs even offer extra benefits like tax credits or exemptions. And let's not overlook tax cooperation. DTAs often include provisions for sharing information between tax authorities, ensuring that everyone pays their fair share. But remember, the perks of DTAA can vary based on the specific agreement between India and the country of your residence. So it's always wise to consult a tax expert to understand how it applies to you. That was a lot, right? We'll do a short recap, and do not worry, I won't bore you. Understanding the status of an NRI is essential, governed by both Income Tax Act of 1961 and the FEMA Act. This status dictates your tax liabilities, particularly concerning income earned in India. In India, income is classified as earned when received, like salaries, while accrues relates to income due but not yet received, such as interest on rent. NRI's taxable income sources include house property, salary, investments, and capital gains. Here's a disclaimer. Please be aware that tax laws and rates can change over time. Additionally, the actual tax liability for capital gains tax may vary based on various factors. Please talk to a certified tax professional before filing taxes in India. When filing taxes in India, NRIs should use ITR 2 for filing returns in all instances and Form ITR 3 for businesses. That's it for the video, guys. If you like this video, hit the like button and subscribe to Groww NRI.